All right, check this out behind me, guys. Number 8 and number 9 together in one video. Today, we're going to be talking about the turn of the month effect and then also its friend, the turn of the year effect. And what's interesting about this, and I had to see this, the charts to believe it, and I'll post this in your notes, the actual returns that we see. And what we find here is at the turn of the month, stock prices significantly rise on the last trading day of the month of every month, trading day of every month. Two, and through first 3 days, the first 3 days of the next month, through the first 3 days, trading days of the next month. What that means is a lot of the pricing action in the stock markets or all of the returns that are happening take place on the last trading day and the first 3 trading days of the next month. So all of this action happens in 4 trading days, and the rest of it is basically flat. So I saw somebody showing that over the last 50 years, if you only traded in these days and didn't do anything in the other 20 whatever trading days of the month, that you would have still the same returns that you would have not exposing yourself to the market through this whole time. I am not a believer enough to actually change my money around in that way, but I do have a strong theory around this that nobody really talks about. And this goes just around most people's retirement investments and other interests and dividend income. They typically come at the end of the month. And for most investors like myself, if you are a retirement investor, that money goes straight away into retirement funds, stock funds, which ultimately are long only. So you're buying more stocks, even if you're buying those ETFs or mutual funds. And that is going to push the market up all at around the same time between the last trading day of the month and through those first 3 days as these retirement contributions come in. And even as a portfolio manager for a long time, you are constrained to buy as soon as you have that money. You can't just hold it on the sidelines. But I've noticed that, and I would be interested to see if this has gone away recently, because some of the portfolio investors or portfolio managers are getting smart to this. So let's think about if you're a portfolio manager and you have flexibility on when you can invest new money coming in, when would you invest it? I would say if I have the money in hand, I can go right before that last trading day, get that new money in so I could ride that first wave of this end of the month effect. If I don't have that money, I'm going to wait till the end of the first 3 trading days of that next month and then start working my way in once everything has theoretically flattened out after that period happens. So that's how we could play that. And once again, though, a efficient market hypothesis would say that who cares what day on the calendar it is? It should not matter. If prices are priced correctly, then there shouldn't be any fluctuation. They will all wash out over a long period of time. But turn of the month effect is something that is historically has been some major pricing action. Its friend is also called the turn of the year effect. And this is where we see stock prices rise on the last trading week of the year. Last trading week of the year continued into the first 2 trading weeks of January. First 2 trading weeks of January. You see these abnormally large returns. Now, it's not as robust and high and significant, but there is something going on that is showing, hey, these 3 weeks of trading happen to have higher returns than all the other 49 weeks. So once again, you could have a theory of people changing their portfolio. Maybe there's some tax strategy around the new year where you're tax harvesting some of your losers, or you're trying to get into some new stocks in the beginning of the year, and that's going to pump it up. I believe that's called the January effect, where people are overly optimistic as they're buying their new stocks in the beginning of the year. I'm going to stick with my theory about retirement prices, 401k, people getting their end of the year bonuses, end of the year contributions caught up, and where you get hit with an inordinate amount of new money coming in, and that portfolio managers need to put to use. So we see that pop. And once again, if I see this rise in stock prices in the last trading week of the year in December into January, if I can get money in early, then I want to contribute it right away to ride that wave. If I can't, then I'm going to try to hold off as much as possible through the middle of January and then work my way in once things have either gone down or have stabilized. That's just my thought around it. Fortunately, I'm not a portfolio manager. I just only talk about it. So anyway, that is number 8 and 9. When we come back, I've got number 10 waiting in the wings, and we are done. We're making our way through. Hope you're enjoying this. If you have any questions, let me know. Otherwise, let's keep moving. Next video.